Most traders think volume profile tells them where price traded the most. That's already a mistake, because the market doesn't operate on one distribution. It operates on multiple auctions, layered on top of each other, time frames fighting, participants competing, conviction shifting. And when traders collapse all of that into a single volume profile, they completely miss what the market is actually doing. This indicator fixes that. Right here is a tool that exposes multiple volume distributions at once, revealing where acceptance truly formed, where participation shifted, and where price is most vulnerable to rotation. Not levels, not lines, auction structure. Today, I'll show you why most traders misuse volume profile, how this indicator exposes institutional behavior, and how to trade from areas where real decisions were made. Let's break it down. If you think all high volume nodes mean support or resistance, you're already on the wrong side of the trade. To add it, open TradingView and search Multi-Distribution Volume Profile by Zierman. Once applied, you'll immediately notice something different. This isn't one volume bell curve stretched across your chart. It segments price action into separate distributions, each representing a distinct auction phase. Each distribution has its own value area, point of control, high volume acceptance zones, low volume rejection zones. This matters because markets don't trend in one clean cycle. They rotate, pause, rebalance, and then rotate again. This indicator lets you see each rotation separately, instead of blending them into one misleading structure. Now, this indicator is powerful, but here's the reality. You'll learn this setup perfectly, but miss when the best moves happen. That's why I now automate proven strategies like these. So I no longer miss the best setups, and can trade whilst at asleep or doing whatever, with strategies ranging from forex to futures and gold. The best part is they even work at prop firms too. So if you're serious about getting funded and actually growing your account, but don't want to waste months trying to figure it all out on your own, click the first link in the description. You'll get access to the exact strategies hundreds of traders are using to trade fully passive. Here's where most traders misinterpret volume and pay for it. Most traders see a high volume node and think, strong support. Wrong. High volume means acceptance, not direction. It means the market agreed on price temporarily. What matters is where that acceptance sits relative to the current auction. Multi-distribution volume profile solves this by showing you which acceptance zones are active, which ones are legacy, and which ones are being abandoned. When price leaves one distribution and starts building another, that's not random movement, that's a change in market agreement. And those transitions are where the cleanest trades live. Now let me show you how institutions actually use these distributions. Phase 1. Distribution context. Before you even think about entries, you identify the current active distribution. Where is price accepting value right now? If price is rotating inside a distribution, fades and rotations dominate. If price leaves a distribution and fails to return, continuation dominates. This immediately tells you what type of trader you should be. Mean reversion trader inside distributions, momentum trader between distributions. Most traders mix these and get chopped. This next part is where most retail traders completely lose the plot. Phase 2. Distribution migration. When price approaches the edge of a distribution, pay attention. Edges are decision points. If the price is rejected quickly and rotates back inside, acceptance remains intact. If price pushes through and volume builds outside the prior value area, the market is migrating. That migration is critical. It means participants are repricing value, not just reacting to a level. This is where breakouts actually work, not because of candles, but because value has shifted. Here's how you avoid fake breakouts that destroy most traders. Phase 3. Acceptance versus rejection. Not all breakouts are equal. If price breaks from one distribution into low volume space, expect speed. That's rejection of prior value. If price breaks and immediately builds volume, forming a new distribution, that's acceptance. Fake breakouts happen when price leaves a distribution but fails to attract volume. Real moves happen when volume follows price and builds a new value area. This indicator makes that distinction visible. This setup looks good, but you're already too late. By the time retail sees the signal, smart money is already taking profits, which is why we've built AI, automated algorithms that trade every major market, forex, futures, and commodities. The best part? You can trade these too, completely hands-off. While you're at work or sleeping, the automation executes proven strategies, even at prop firms too. No more burning through your account testing random indicators that never work. Skip all that and go straight to what actually works. But I'm only taking on 30 new traders this month because I personally walk everyone through setup and onboarding. So if you're serious about finally making this work, click that first link below right now. Now let's turn this into a repeatable execution model. How to trade it. High probability setups follow this structure. Identify the active distribution, observe price behavior near distribution edge, watch volume response outside value area, trade in the direction of acceptance or rejection. Entries on retest of distribution edges or inside new developing value. Stops just inside the prior distribution. Targets next distribution boundary or unfinished auction zone. You're not trading lines, you're trading value transitions. Settings matter, but only if you understand what you're tuning. Settings by Market Forex. Use medium segmentation. Forex rotates cleanly between value areas. Crypto increase segmentation sensitivity. Crypto builds and abandons value aggressively. Stocks keep segmentation moderate. Stocks respect prior acceptance zones longer. Indices. Default settings work best. Indices form clean multi-auction structures. Gold use fewer, broader distributions. Gold auctions slowly but decisively. Thanks for watching. I'll see you in the next one.